The appetite for lending, I kind of equate it to being on a pendulum. So sometimes, like a few years ago, it was on one end of the pendulum. There was a lot of liquidity in the market. I hate to say it, you're probably never going to get a mortgage loan sub 3% again. And you probably won't get a commercial loan that's 4% again. Like, this might kind of be the new norm. You might want to do it now because when rates drop, guess what? There's going to be more people that want to buy that property. There's going to be more competition. Right. So if you can find a lender that can be creative, mitigate risk, and to their credit team to approve your loan and that will stand by you, I think that's really important. It's all about relationships. And if I can't help someone, I do know other people that have different products, different lending standards, something that might fit them better.
Hey everyone, and welcome to another episode of Commercial Connections Investing with Confidence. I'm Brittany, the producer of the show. And today we have an incredible guest joining us, Michelle McCoy. Michelle is a seasoned financial expert and lender with experience across banks and credit unions of all sizes. Born and raised in Hawaii, Michelle moved to Oregon and attended the University of Oregon, where she earned a degree in business with the emphasis in finance. Now, with 25 years of experience in banking, she's worked across financial institutions of all sizes. Through mergers and career growth, she's gained experience in regional banking and has spent the last 5 years at a credit union. Beyond her career, Michelle is a dedicated mom, a cancer survivor, and a passionate duck fan. She loves being outdoors, whether it's camping, hiking, or playing pickleball, her latest obsession. Leading today's conversation is your host, Rene Nelson, an award-winning CCIM in the Eugene, Oregon area. Before we dive in, I just want to welcome you to the show, Michelle.
Thank you. Thanks for having me, Brittany and Rene.
Yeah, we're so excited, Michelle.
This
is like Super Bowl day for me to get to visit with you and share your knowledge and your information with our listeners. I am so excited. Most lenders are a little leery to come on because they're like, oh, I'm regulated and I don't know what I can say and I don't want to get into trouble. And really what I want to do is just talk to our audience, because I get calls all the time where people say, hey, I need to go get a commercial loan. What do I do? They're clueless. So walk us through, when somebody is going to come and see you and get a loan, what's a couple of things you want them to know and how do they get ready?
Yeah, that's great, because when people come in the door and they want a commercial loan, it's definitely different than getting, a 1 to 4 family loan. You're talking about a commercial investment here, typically bigger dollar size, more risk. And it is different financing structures than a typical 1 to 4 family loan, which you'll typically get a 30-year fixed rate or a long-term mortgage on that. Commercial loans are definitely structured differently. And so to new people, it is a new experience that you kind of have to walk them through. But as far as looking at commercial real estate properties, you're looking at the investment itself and the income that that property will generate. But also, we're also looking at secondary sources of repayment. So we try and tell the applicant that we're not just looking at the real estate investment itself, but we also want to look at you personally, because you're likely going to have to personally guarantee the loan, what you look like. So we're going to be asking for, your personal financial statement to see your liquidity, also to see what other kind of outside cash flow you have. If the real estate investment runs into vacancy issues, what can you do to support the loan request? So we walk them through that and definitely talk through the differences in the loan structure. How I had mentioned that, you're typically not going to get a long-term fixed rate, because our loans that we make, they stay on the bank's portfolio on our balance sheet. So we don't package them up and sell them in the secondary market. We hold them on our balance sheet. So typically the longest rate lock that a person will get is about 5 years, and their rate will reprice every 5 years. So to someone who hasn't done commercial financing, that's like an eye opener. They're like, what do you mean? I don't know what my rate's going to be in 5 years. No, because we price our loans based off of the cost of our funds, which is our deposit base, which that changes, because at the end of the day, banks, how we make money is we buy and sell money. So we basically are buying our depositors' money, people that have savings and checkings accounts, and then we we lend out that money. So we only want to lock our rates for about 5 years typically. So
And you mentioned kind of, I always call it a global financial statement. So you're looking both at the property as well as the person's individual personal financial statement. What do you want to see for liquidity? Do you have kind of a rule of thumb?
I would say that at least 3 to 6 months of payments in liquid assets is good. And, we can't really consider retirement accounts because those are protected assets. So we're talking about cash deposits, marketable securities, that would count for liquidity.
Typically, there's a minimum for a commercial loan amount also, right? I mean, I know a lot of commercial lenders don't like to do loans for what, under 500,000? Kind of what's the minimum threshold?
Well, I guess it depends on the institution that you're talking to. Bigger institutions, they have different departments that handle, let's say, the under 1 million and then 1 million to 5 million and so forth. I mean, at Selco, I handle them all. I handle a commercial loan request for, I know we're not talking about autos here, but like I would finance a truck loan for someone all the way up to like a $10 million project. We handle it all here at Selco. But yes, some banks do have size limits. It's just the channel, the department that you would use. They generally still would have someone that could handle the smaller requests, but they just break that up into different departments, whereas I am the commercial lending department here. So we do it all
You
sizes.
guys are on fire right now. For Eugene, Oregon, you are dominating the commercial money market. I hope, or commercial lending. I hope you know that you're at the top of the heap right now for Oregon.
Yeah. I've heard people are happy to get options for us. I feel like we're still competitive out there. Our appetite is still good for lending right now.
So walk us through that too. Why do banks and credit unions vary? Like, some banks are just literally saying, sorry, doors are closed for lending right now. What's happening there? Why is that happening?
Yeah, that is a great question. The appetite for lending, I kind of equate it to being on a pendulum. So sometimes, like a few years ago, it was on one end of the pendulum. There was a lot of liquidity in the market. Buyers were coming in with a lot of down payment. The economy was going. So banks were lending, and we had money to lend because our deposit base was really high. There was so much stimulus money put into the economy, whether companies were getting PPP money or, they were pandemic money for individuals. Our deposit base was really high. So we had money, banks had money to lend out those few years. Well, now things have changed. People are using their savings. And so basically deposits have depleted at a lot of institutions. And so now they're being very picky at what kind of loans they want to do because we only have so much money to lend out. And now we are going to be picky. So that pendulum has shifted. For some banks, like you said, Rene, I imagine what you're running up against or hearing is some banks are even saying, nope, no new clients. We will do loans, but only for existing clients. Another thing you'll hear is we will do loans, but we want your deposits. We want your deposit relationship. Or, we want to make this a sticky relationship. It's most people, when you say sticky relationship, it's bringing over deposits because it's really hard to open up new accounts and move your accounts anywhere. It's really easy to get a loan anywhere. But when you want to, establish your deposits, it's like ordering checks and your ACHs, and it's just a really sticky thing. So banks are requiring deposits. Or they're saying, another thing they're saying is we only want to do owner occupied loans, meaning that the business that is occupying the commercial real estate operates out of it. It's not leased to a third party. So they're just really being particular because of the bank's liquidity situation. They only want certain loans. I think the fortunate part about Selco is our deposit base is so strong because we're a credit union. We pay, on average higher rates on our savings accounts. So our deposit base is pretty strong. So we are still on that pendulum. I say we are still in the market to lend and we are looking at things a little more carefully, but we definitely have money to lend. Like our loan to deposit ratio is lower than most, meaning we have the capital to lend out.
That's great. So when you talk about owner occupied, do you typically see people take SBA loans? And what would be the benefit of an SBA loan?
Yeah, so an SBA loan is geared towards owner occupied. It really is only owner occupied. You have to occupy more than half of the building to qualify for an SBA loan. The typical commercial real estate loan that is done through an SBA loan is through the 504 product. And what it allows the buyer to do is to come in with less down. A lot of times people don't have the 30 plus or minus percent to put down on a property. They may
Mhm.
only have 10%. And so the SBA 504 loan, what it allows a buyer to do is come in with as little as 10% down. So what happens is the bank will be in a first position. They will do a first loan at a 50% loan to value. And then they can get a second loan through the SBA up to a 40% loan to value. And that allows the buyer to just put down 10%. So that is very common for owner occupied properties, especially if they're startups or they don't have a huge down payment. SBA loans, you do have to jump through a lot of hoops to get. So not everyone who, is doing an owner occupied loan, that's a good fit for them necessarily. If they can get conventional financing, that's likely the route they do unless they really can't come up with that bigger down payment.
Okay, that makes sense. So you're helping one of my clients right now buy a small commercial building. Well, I'm actually helping them buy the small commercial building, but you're doing the financing. And my
Correct.
question is, when you go through that process with them, because this is a new adventure for them, walk me through your eyes. How do you put that deal together? What are you looking for? Did you have them write a business plan? Just kind of walk me through how you start to underwrite and look at a loan scenario like that.
Yeah. So these individuals, they come from a family with a long history of operating these types of businesses that they want to put in this building. So they do have the family history of that. The other thing is that they have very good secondary sources of repayment. So should this new business venture not go well, they have very strong W-2 jobs. So they're not relying on this business to make them a paycheck. So they have management experience as well as outside cash flow, and they are coming up with, I believe it's over 30% down. So they didn't need to get the SBA loan. And in this case, we didn't go through, make them write out a business plan or anything like that. If they had done the SBA route, guaranteed the SBA would have wanted to see that because this is a new startup for them.
Okay. Where do you see people have problems and fail at trying to get a loan?
Well, I would say if their credit is not good, I mean, obviously that points a lot to character, looking at do you pay your bills on time, but also just having secondary sources of income is really important rather than just looking at the asset that we're taking as collateral because we may have an appraisal right now that says this is the income that this property generates, but so many things can change in the market. All of a sudden competition comes in, they build all these new units down the street, then there's more competition, your rents go down, expenses can go up. We all know insurance is highly unpredictable right now. So looking at secondary sources of repayment is really important and just making sure applicants know that you need to show that you have the liquidity and outside cash flow as an additional source of repayment for the lender should the real estate property not perform.
Okay, so I want to talk a little bit about the property and the steps from the appraisal to the phase one. But before we do that, let's talk about loan covenants. So
Mhm.
when somebody takes out a loan with you, they basically sign an agreement that every year they'll produce financial statements, right? To document the cash flow. Walk me through that.
Yeah, it's very typical to have financial reporting requirements, which is another thing that's new to individuals that have never got a commercial loan request. You're used to getting a home mortgage and you never talk to your lender ever again. You just make your payment. Well, on the commercial side, like I said, so many things can change on this investment property, the examples that I just went over. So, yes, it is very typical to require annual financials, annual tax returns, depending on the property, a rent roll to show who your current tenants are. So that would be a covenant on the loan as far as financial reporting goes. And then to piggyback on other kinds of covenants that we do set up financial covenants like metrics that they have to meet. So a very common one is a debt service coverage ratio. So that just measures the income of the property, how strong that is compared to the debt that you've put on the property. So a typical debt service coverage ratio could be a minimum of 1.25. So what that means is for every dollar of required debt payments, you have $1.25 of income or more. We're requiring a minimum of 1.25 or higher. So that would be another type of covenant that the borrower should be aware of that would be measured when you submit your annual financials. That's how we are able to check that covenant.
So talking about debt service, debt coverage, that leads also then to it's not a typical rule of thumb like 30% down, 40% down. The first thing you're probably double checking is what's the net operating income of the property? And then you back into the loan that they probably qualify for, right? Because you're looking at the debt coverage.
Yes, very much so. We size our loans, meaning we determine the loan size based on two primary factors, loan to value and cash flow coverage. Oftentimes these days, it's more so being sized by the debt service coverage ratio, making sure it can cash flow.
Are you seeing people get rejected from loans even if they hit the 1.25 sometimes?
Depending on the property type, yeah, certain property types you're going to want, a higher
Okay.
debt service coverage ratio. If it's a special purpose property or something that has a higher risk to it, higher turnover risk with the tenants, it's special purpose where the likelihood of someone, like, for example, I just got presented a deal and it was for a retail property and there's a coffee shop operating out of it
Mhm.
and they're paying $5 a square foot triple net, which is very high. And I hope the business continues to operate out of there and be successful. But if it needed to be re-tenanted, yes, my appraisal is based on the current lease, but what happens if this property gets vacant and there needs to be another tenant? Then you look at comparables and see what are people paying for similar retail space like that. I doubt it's that high or
Okay.
even remotely close to that. So that's why you require a higher debt service coverage because then you're going to limit the loan amount and limit the exposure.
Okay,
Yeah.
so part of my desire in this podcast is to use Brittany kind of as my test case. So when we finish, I always want to see from Brittany's perspective, what has she learned? So Brittany, to correlate what Michelle just said about the rent, where that coffee shop was paying $5 a square foot, right
Yeah.
now in the Eugene market, rental rates would be closer to like $1.35 a square foot.
Why do you think they would be at such a high place right now?
You'll see some high-end coffee shops. I won't name names, but some of them start with an S and some of them start with a D and have these awesome drive-throughs where you can go
Yes.
through and they provide you amazing coffee. Well, those type of brands, because they're
Yeah.
such high quality and they're a destination coffee place.
Mhm.
They'll pay higher because they know that they're going to have the demand. But you compare that to a mom and pop coffee
Mhm.
shop who's just starting out and, they're going to try to let their kid be a barista to create a job for them. They're not going to be able to afford $5 a square foot. I mean, they better have some they better offer cats that you can come sit and have
Yeah.
coffee with or,
To make that income back.
ponies or
Yeah.
something.
Right.
Yeah.
Right.
Yeah. You
Yeah.
got to
So
do
that makes
something.
makes
So,
sense.
hey,
Yeah.
I'm going to just segue real quick. Last night I saw on TikTok an amazing thing. It's a coffee shop. It's a huge sand pit and kids can come in and play with dump trucks and different things while the
Uh-huh.
moms sit and have coffee.
Oh.
But then in the afternoon, the dads get to come in and they bring out remote controlled dump trucks and scoop shovels and stuff.
Oh,
They showed this bar with about 30 dudes sitting there drinking coffee, and they're all like playing video games,
oh,
just moving dirt around. It was so crazy.
oh
That's
gosh.
hilarious. You got to
That's
diversify
awesome.
your clients. Yeah.
Yes. Gotta
And oh, by the way, you could click on the link in the TikTok and get this business plan to open this coffee shop. So, Michelle, if you find somebody that wants to be entrepreneurial in Eugene, you could tell them to check out TikTok because it'd be a hit.
They have the idea
cute.
already for them.
Yes. Yeah,
that's awesome.
absolutely. Absolutely. So let's finish up about loan covenants. What happens when somebody took out a loan 5 years ago with you or 4 years ago and they got super cheap money? I'm talking stupid money. You know, they got 3%, 3.5%. I know a lot of people that did that, and now their time is ticking off. So when they get to year 5 and they need to refinance, or their interest rate's going to reset, but now it's going to reset at 6.5%, but maybe their cash flow hasn't jumped significantly. What the heck do they do?
Yeah, that's a great question because it's definitely where we're at right now. It's 2025. In 2020, rates were rock bottom. I'm having loans repriced right now, and I was looking at what the index was, what, the benchmark, and we add a credit spread over that depending on the risk of the deal. That 5-year, we use the Federal Home Loan Bank index. That index was under 1% for the base before you add the credit spread. That same index is over 4% now. So yeah, it's like 3.5% higher, I would say, on most deals that you're seeing an interest rate jump from what they had, had their loan priced in at 5 years ago to what it would adjust to today. What I would say is a prudent lender would have done a interest rate sensitivity analysis. And so we knew when we were doing these loans, yes, we had to lend out money at that time. And yes, we had floor rates, not like we were giving it to them at like 2% or, because we still have to pay our depositors. We sensitized the loan rate knowing that in 5 years, there's going to be a rate adjustment. So most lenders have kind of a model where they play around with like, what does the debt service coverage look like if rates change? And so sometimes you lower the loan. If you were prudent, you would have kind of, depending on the situation, you might have tapered the loan down a little, knowing that there wasn't a high likelihood of income to increase down the road to offset a potential higher payment. So interest rate sensitivity analysis would have been important to do at loan origination. I would say a lot of the loans that we are seeing repricing, thankfully, rents have increased over the last 5 years, as you know, in all property types, whether it be industrial, whether it be multifamily. So they seem to be able to, the ones that I've been seeing, absorb the higher payment just because their income is, more than, let's say, 3% higher. The rate's going up 3%, did their rents increase at the same rate? Thankfully, it seems to be the case that it is. If not, then we look at the loan to value. Maybe we talk about restructuring the loan because obviously we don't want past due payments. We want the loan to perform. And so we look at, do we need to reamortize the loan? Do we need to maybe lower the rate with a buy down today to kind of make the payment more palatable for the customer? So there's different options that you can work through.
Oh, that's good to know. Do you sense that we will see some foreclosures coming, or do you think it'll all just kind of, like you said, with rents going up, people will be able to, and hopefully, if the economy changes and inflation softens a little bit, maybe everybody will get some breathing room. What's your sense for kind of the commercial market and what's happening?
Well, I am really hoping for this soft landing. I am really hoping we just kind of skirt along. Nobody wants an '08 and '09 again. When I talk about that pendulum, how, lenders' appetite swing. I remember in '08 and '09, it was like I said, one end of the pendulum was like foot on the gas, do loans. It was like brakes, no loans. All we are doing is problem loan monitoring. All we are doing is reappraising our properties that we have as collateral. So I am hoping that we can manage through this where we're at right now. I mean, yes, there is a little bit of distress out there, but it's happening. I see it more so on the consumer side, which could trickle down to the commercial side. I mean, yes, there are delinquencies, for Selco, I would say, like more so on the consumer side, whether it be auto loans, that sort of thing, but not really on the commercial side quite yet. I think where you see if there would be delinquencies on the commercial side, it was people that levered up properties too much. A lot of people wanted to take out cash out to go and buy that next investment. That could lead to problems if you over levered a property.
So, talking about over leverage, let's also talk about personal guarantees because our listeners may not be familiar with that. And like you said, it's a little shocking. So, walk me through a personal guarantee and how that works on a commercial loan.
Yeah. So the reason we require personal guarantees is most people take out their commercial loan in an entity name.
Mhm.
A lot of times it's an LLC, a real estate holding company, which limits the liability to them personally. So if we only made the loan to the LLC, we could not reach out to the owners of the LLC, AKA the members, and ask them to step up and shore up this loan. So that is why commercial loans typically require a personal guarantee because you are personally guaranteeing the loan that should this investment go sideways or have issues, that you will be contractually obligated for the loan as well. So that's why we ask for all the personal stuff too, even though they're saying, but it's a business loan. It's a business loan. Yes, it's a business loan, but we're also asking you to personally guarantee it.
So, what do you do, Michelle, when you've got maybe two partners, two friends that have created a partnership or bought property together, and now one wants out, death, debt, divorce, whatever, somebody needs out? How do you deal with that? Do you just look at the person that wants to stay in the deal and basically re-underwrite it before you decide if you're going to let the other person out of the deal?
Yeah, exactly. We would look at what does the deal look like without, did we really need the both of them on there, or does the remaining person on the loan serve as another good secondary source of repayment?
Okay. Well, I've done a lot of talking. So, Brittany, I know you've got some questions in your mind. What would you like to ask Michelle? What do you think our listeners want to hear?
So we're seeing like a possible balloon coming, like you guys have been talking about. They got the low rates and then they're going to have to come back and refinance. When would you say investors should refinance or should they wait? What are you seeing like in that space?
Yeah, as far as the uncertainty with where rates are at, I think is the question that you're asking. People wanting to refinance right now, it would really, most people do have lower rates than what is right now. So I would say, is there another driving factor that's causing you to refinance? Do you need to buy out a partner? Do you need cash out? And you have to determine, is that worth taking a slightly higher rate than what you already have? So that's the refinance situation that people have to determine whether it makes sense right now at today's prevailing rates to refinance. When it comes to purchases, you also have people that are on the fence right now. Rene probably deals with them all the time where they're like, well, I don't know. I think rates are going to go down. I'm sitting on the sidelines. I mean, thankfully, rates have gone down and it seems like more people have gotten off the sideline as of late. But, what I would pose to them is I think we've just been so accustomed to very low rates. I mean, if you only got into the lending market post '08, '09, you have no idea what rates higher than 7% are. Like that is the thing, but we're just so used to low rates. I hate to
Yeah.
say it, you're probably never going to get a mortgage loan sub 3% again. And you probably
Yep.
won't get a commercial loan that's 4% again. Like this might kind of be the new norm that I think I always tell people, well, mid sixes, it's not the worst rate to ever get. And I think that's why people are finally jumping off the sidelines, knowing that there has been some rate reductions. They're thinking, okay, well, it certainly wasn't the worst rate I could have got 6 months ago. Rates were higher. So now I might want to jump in and do something. So if it pencils right now, like at the rate that it's at, then you can always refinance it down the road should rates drop. I guess that's to answer your question if people are on the fence with rates right now. If it works for your cash flow right now, then you might want to do it now because when rates drop, guess what? There's going to be more people that want to buy that property. There's going to be more competition. So you just have to weigh out your situation and kind of determine if it makes sense for you.
Yeah. And I think another question I had is, do you see anything in your area for like floating rates? Is that a thing where people are coming in and maybe they can get a different deal on a floating rate? Is that popular?
Well, what's interesting is we kind of have an inverted yield curve where floating rates are actually higher than long-term rates. So yes, you could get a floating rate, but actually the long-term rates are lower because they're thinking that rates are going to drop at some point.
I was just going to ask you about interest only because I know in the past that's a lot of investors have liked that interest only. Is Silco doing any interest only loans?
You know, we had a program a couple years ago where we did do 12-month interest only, especially on multifamily deals. You know, if a person was buying a property and going to renovate it and kind of want to give them time to have that turnover, and release it up at a higher rate, we did have a program like that. I think it's just a case by case basis that we would consider that. Yeah.
So if someone is coming in and they got a loan back then and they're coming in, the underwriting that's going to change because of like the new market, right? Does that mean like their requirements change, like the DSCR, things like that? Like those are going to change when they come back into you guys to get possibly another loan or refinance? Is that how that works?
Is it on the same property or a different property?
I think so. Yeah, like on the same property if they haven't paid off the
Yeah.
loan yet.
Okay. I see what you're asking. Okay. So that's a great question. So a lot of our commercial loans, they're not fully amortizing, meaning there's a balloon. So typically it's a 10-year maturity. So in 10 years, the loan comes due, completely due, and you have to come to the lender because so many things change in the market and refinance that balloon. And it typically means a new appraisal, looking at where the market is at that given point in time. And then we look at it, yes, credit standards could change at that point in time, depending on, what's going on in the world. Are we seeing a real estate crisis or is things just at norm, So yes, you do have to, reevaluate and look at the deal at that maturity where credit standards are at that point in time. You've paid down on this loan for 10 years. So, and let's hope 10 years is a good amount of time to hold a property where you would think you'd have some sort of appreciation unless we totally went backwards. 10 years is a good hold period to weather out some sort of storm.
And when you go back through that underwriting process, let's say it's 5 years, do you have to also then have a new phase one environmental? I'm assuming you update your appraisal. Do you have a new phase one environmental inspection done?
No, if we don't have reason to believe that since we originated the loan that there's been any deterioration or environmental risk concern, then we wouldn't. We can run a cheaper report. It's called a VeriCheck. It checks databases. It's not eyes on the ground like a phase one actually has someone go out on site. We could run a report like that, which is $100 some odd.
Okay, great. So, Michelle, what's one thing you would want every borrower to know that was either thinking about refinancing or wanted to buy a property and come in and get a loan? What's one thing you want them to know?
I would want to work with someone local rather than, a lot of these bigger institutions, you don't have someone local. It's really nice if you have a problem down the road. to have someone to talk to, someone that is responsible for your loan. They're not just going to put it on the books and then move on to the next deal. I think it's so important to work with a local lender that knows the market and that will be your advocate should you run into issues down the road.
You have been an icon in the industry. I mean, you've done this forever since you basically graduated from college. You've either worked at, as Brittany said from your bio, you've either worked at commercial banks, small banks, credit unions. So you probably go to duck football games or run into your clients in the grocery store. So I know from my perspective, when I mention your name, everybody's like, oh, yeah, I know Michelle. And I'm like, well, of
Oh,
course, she's iconic. Everybody knows
oh,
Michelle.
thanks,
So,
Renee. I
yeah,
love
well,
what I do.
yeah, it shows. It shows, Michelle. You're really good at problem solving. You and I have worked on deals over the years, and I kind of equate it to a box top for a puzzle. And you're really good at putting the pieces of the puzzle together to make that deal go and really ease the mind of the buyer too, because it's stressful. They don't know if they're going to be able to qualify. They have no idea what they need to do. Most of them, when they're starting out initially, what they need to do to jump through the hoops to get qualified. And underwriting is also, always a troublesome thing for some people. I bet that's why you enjoy pickleball. Is that where you just go get your frustrations out from underwriting?
It's about strategy, making it
Yeah.
work, right? Yes.
That's awesome.
I
All right,
love
I'm going to
pickleball.
ask both of you guys a question. So my goal as we wrap up is to see what Brittany learned today. So Michelle, in one sentence, tell Brittany what was important about your presentation or what you would want somebody to know about commercial lending.
So I think that when someone is looking for a commercial loan, they need to find a lender that's really going to be their advocate and also one that can mitigate any risks that your deal might have. Every deal has risks to it. Banks are in the business to make loans, identify the risks, and mitigate them. So if you can find a lender that can be creative, mitigate risks, and to their credit team to approve your loan and that will stand by you. I think that's really important.
Oh, that's awesome. All right,
Yeah.
Brittany, tell me what one thing you learned today.
So I definitely learned how important it is to use like a local company for your lending. And then this business feels a lot about relationships and networking because I feel like you were saying, when it comes to someone advocating for you and identifying those risks when you're going up for a loan, well, maybe they know someone in the industry. If they start seeing like a risk that's coming through, they could probably pair you with someone who could help you either like plan your exit strategy when you're coming in for the loan, or if they see like a maybe like a construction issue or something like that, maybe they know someone locally who you can partner with and get you like where you need to be in terms of like getting your loan right. If that sounds right. Yeah.
It makes sense to me. How about you, Michelle?
Yeah, definitely. It's all about relationships. And if I can't help someone, I do know other people that have different products, different lending standards, something that might fit them better.
Yeah. Hey, Michelle, we'd love to have you back at the end of the year. I think it'll be interesting in 2025 just to watch the climate change for just on a national level as well as interest rates. And I think we should have you back at the end of the year and let's just hear your recap of
Oh, I would
what
love
it
to
was.
see. I would love to see where this goes. I wish I had a crystal ball, but we'll know, at the end of the
Yeah.
year. Yes. Hopefully.
Yeah.
Yeah. Get more
That's awesome.
certainty. Yeah, for
Yeah.
sure. I'd
Hopefully
love
it's
to
a
come back.
I hope it really works out for, the people that you've partnered with and we can see them take this thing like farther and not go into those delinquencies and things like that.
You definitely. I don't want another 09, 08, 09, please.
No, amen to that. Michelle, thanks for being here today. We really appreciate your time.
Thanks, ladies.
Thanks.
Bye.
Thank you. Bye. Next time on Commercial Connections.
My jaw about hit the table because the maximum loan I think we could do at the credit union at the time was like 3 to 5 million to one borrower. And so I'm like, this guy's got like 3 to 5 times just cash to spend. And so I'm looking at him like, okay, for one, you know someone who's going to have $15 million of cash to spend. Never met anyone with that kind of resource to go invest in real estate. So I'm like, okay, as much as I feel like a small fish in a big ocean, this is a good room to be in if these are the types of deals that we're talking about. So joined as a power partner sponsor, kept going to CCIM for the best part of a decade. And then right around as COVID was hitting, I realized as a lender, you could actually get the CCIM designation. So you take the 4 classes, you have to submit your portfolio of deals that you've done. I was like, okay, I think I'm going to go for it and get this designation. Started the classes, and honestly, I absolutely loved the classes.